Hello, everyone. This is David Zern with Avalara, and welcome to today's webinar, Streaming Tax Complexity, The Unknowns Can Cost You. On today's webinar, we have Steve Lakoff and Toby Barter. Steve is the General Manager of Avalara for Communications, and Toby is an attorney and senior tax strategist in the Avalara Communications business unit. You can read more about them by clicking on the light blue icon called Speaker Bios. Before we jump in, I wanted to go over a few basics of ways you can interact with us during today's webinar. First, we're recording today's webinar, so if you want to listen to it again or even share it with a colleague, you'll receive the recording within the next 24 hours. Also, I want to review the orange screen you're looking at. First, any and all of the windows can be completely customized. Feel free to move or resize any of the windows. Along the bottom of the screen, you'll see several buttons or widgets. I won't go over all of them, but did want to highlight a few. The purple Q&A button is there because we set time aside at the end of the presentation to have Toby and Steve answer any questions that you provide during the presentation. Feel free to submit any questions at any time. I will answer the ones that I can, normally of a logistical nature. The ones for our experts will be answered during Q&A by the team at the end of their presentation. Any questions they do not get to, we will try to answer by email after the webinar. The green resources button is there for a list of resources with additional pieces of content on the different topics we'll be discussing today. As well, the slide deck is available. That is the first option for you under resources. I normally tell people, go ahead and click on the links that interest you and leave them open in a separate window, so they'll be waiting for you after the presentation. There's also a yellow help button. If you have any technical questions, issues with volumes, any of the windows, anything like that, those frequently asked questions can be answered right there. Now that housekeeping is out of the way, I'll go ahead and turn the webinar over to Steve to begin. So Steve, thank you very much.
Great. Thanks, David. I guess first on behalf of Toby, myself, and Avalara, just wanted to thank everyone for taking the time to join us for this webinar. By way of introduction, I've been at Avalara for over a year, but just recently moved into the role of GM for our comms business, which focuses on companies in the communications and media industry. Prior to Avalara, most of my career has been spent in the telecom and media space, specifically with SaaS and cloud services. In the last few years, immediately prior to joining Avalara, I worked in the streaming media industry exclusively, both at Disney Streaming Services and Comcast in their Comcast Technology Solutions business unit. So I love the streaming industry, and so I'm uniquely excited about this webinar. Streaming media is an important and growing part of our business. The landscape is quickly evolving. Awareness of these tax and compliance issues is still relatively nascent. So, I think we've got some good information, and the goal here is to provide some clarity around the current tax landscape. First, I just want to do a brief introduction to Avalara for those of you who may not be familiar with our company and solutions. Broadly, we're a technology provider, and we help companies of all sizes automate the major steps of tax compliance. And so that includes everything from registrations to real-time tax calculations to return filings, as well as exemption management. We were founded in 2004. We IPO'd in the summer of 2018. And we operate a multi-tenant SaaS platform. And so, we've grown to the point where we power the tax and compliance needs for over 30,000 customers. And so, this is addressing the needs from very small emerging businesses, to many of the largest global Fortune 500 companies. And so, we support companies that literally cut across all industries. Obviously including comms and media, which is a strategic focus for us and an area of significant investment and growth. An important part of what we do is we provide pre-built integrations or what we call connectors into a wide range of systems that basically house your transactions, and these can be ERP platforms, billing platforms, payment gateways, subscription management services. And so ease of integration is a big part of what we deliver. And over the years, we've invested in our technology and platforms and partner integrations, and that's helped us achieve pretty significant scale here. So you see a couple of stats, right? In 2019, we supported over 17.6 billion API tax calls, and we processed over 2 million returns annually. Okay, so let's get into it. Just a brief overview of our agenda. The way that we've structured this webinar is to provide a little bit of information about the current landscape and some of the trends with cord cutting and the adoption of streaming media services. We want to talk about what those tax implications are, specifically around streaming media. We've got a number of almost case studies, right, for specific states and jurisdictions that I think will highlight some of the considerations and some of the mechanics behind some of the taxes at play. And then we're going to close out with just, some preparation tips, right? So how can you address this changing landscape within streaming media, and some tips. And then as Dave touched on, we're going to reserve some time at the end for Q&A. But first, we want to start with a poll just to get a little bit of a baseline. And so the question here is how prepared are you to collect communication taxes on streaming services? And so we're just going to give this a little bit of time for everyone to fill this out, which I think will help guide us a bit through the webinar. All right, we'll push forward, see what we're dealing with. Interesting. Okay. Well, good. I think this will be helpful, and this will be informative. I mean, it looks like we're split kind of a third in terms of people's understanding and how well prepared they are from a tax and compliance perspective. Okay, so I know it comes as no surprise that cord cutting has achieved mainstream status, right? And the reductions in traditional pay TV are fully and are rapidly accelerating here. And so what we've done is, just in three numbers, we've tried to kind of put some focus around this. The first is in 2019, pay TV providers lost over 6 million subscribers, right? So a big part of that base moved on and adopted new services. And this is a growing trend, right? And year over year, it's picking up steam. And so projected cord cutting is expected to grow at an annual year over year rate of 44%, and that's through 2023. And so, the result here is the revenue and the tax basis is being displaced, right? It's moving from traditional pay TV services, which traditionally have been heavily taxed, to streaming media services, which traditionally have been relatively lightly taxed. And so this is reflected in the OTT streaming revenue growing at 35% in 2019. So, obviously cord cutting is real, it's picking up pace, and that's going to drive a lot of implications for states and jurisdictions and streaming providers in terms of being compliant. So we've got one other quick poll. So with COVID-19 and stay-at-home orders kind of taking hold over the past couple of months, we've heard a lot about streaming adoption during this time period. Who do you think has seen the biggest surge in new subscribers over the last few months? Let's give a little bit of time for folks to fill this out. Interested to see the results here. Okay. So it looks like Netflix is kind of the consensus, followed by Hulu and Disney Plus. Well, let's see what the right answer is here. So, we've talked about streaming realizing lots of growth, right? But COVID-driven stay-at-home orders have obviously created a new catalyst for growth in the industry. So, just to explain this chart a little bit, basically what this is showing is for the, 8 of the top streaming services, each of these bars for each streaming service represent the subscriber adds basically over the first 3 weeks in March, right? And if you look at the horizontal line, that's the pre-COVID baseline per service, right? And then the second and the third line for each is showing what that growth rate is, right? And so there are a number of takeaways here. One is the growth here has just been broad-based, right? Almost every major platform here has realized growth north of 50%. And many have experienced huge growth, right? 150% plus, including, most of these are centered around, standalone subscription services from traditional cable nets like HBO and Showtime. But as you see here, Disney Plus was a big winner, right? So they had subscriber adds growing in excess of 3.5 times their pre-COVID baseline, right? So just massive growth. If I had to speculate, I'd think a lot of that's due to the need to entertain lots of little people who are home from school. But if we think about Disney service, I think the last set of stats I've seen is they're currently at 50 million paid subscribers, and they achieved that in 5 months, right? So just it's been remarkable adoption of that service. And so, while stay at home orders, this is temporal, right? We're going to get out of this. But I think the point we want to make here with these numbers is that the effects of this are going to endure. And they basically created a new baseline for the industry. So the way this is playing out is, you've already got a large subscriber base. And on average, each streaming subscriber subscribes to over 3 different services or subscription platforms. And now with stay-at-home orders, there's lots of additional time to discover, engage with these new services, and binge on the content. So that time spent watching has grown 36% in recent months. And history indicates that these initial signups and trial subscriptions are going to stick and endure, right? The industry average customer retention rate is 80%. And so that implies that lots of these new subscribers are going to stay around for the long term. And this is going to increase the likelihood of accelerating cord cutting even further in the coming months and years as customers get more familiar with these services. Now, from a tax perspective, cord cutting is creating a problem for states and other jurisdictions who are already facing, significant budget challenges that have only intensified in recent months. And so here, what we're looking at is just an average breakout of your traditional pay TV cable bill. And so as you'll notice, the taxes and regulatory charges that are broken out here are material, right? It's going to be, the percentage is going to be based on jurisdictions, but typically averages 8 to 12% of the underlying core service. So, if you extrapolate that across the industry, it's clear that there's significant tax dollars at stake. And so the challenge for states and other jurisdictions is that traditional pay TV services, which have been taxed, right, comprehensively and pretty heavily, are being cannibalized by streaming services, which until recently just haven't been heavily taxed. And so this is hollowing out that tax basis and the tax revenues realized by states and cities. And so over the past few years, cord cutting has worked to cut into these sources of tax revenues. And listed below are some of the most prevalent, comms, tax line items. And so these include franchise fees, regulatory cost recovery fees, local utility fees, on top of sales and use. And so while sales and use is in recent years being taxed more expansively for streaming, the comm taxes traditionally haven't been applied, but that's changing, and it's changing pretty rapidly. So states aren't standing still, right? Over the past couple of years, we've seen increased focus from states seeking not only to impose new streaming taxes, streaming specific taxes, I'm sorry, but also focus on actually enforcing them, right? So, to be honest with you, this slide wasn't hard to put together. There have been a lot of headlines and stories of states have enacted new taxes targeting streaming services. And there's been lots of public debate about imposing new com-style or other streaming-specific taxes in addition to or on top of sales and use tax. So here you just see a few articles focused on new streaming taxes or predictions on the increasing trend around these new streaming-specific taxes, or even taking something that's in a specific municipality and expanding those statewide. And so as you see here, this cuts across California, Georgia, Illinois, states with large populations and a big tax basis, and I imagine where lots of you have active subscribers. And so some of the states and cities have already made the move to start taxing streaming services, and the list is growing. And so with this, I'm going to hand it off to Toby, who can talk a little bit more about kind of the current active landscape for for tax of streaming services.
Yep, thanks, Steve. So yeah, cue the tax nerd. That's me. What we've seen so far, there've been a fair amount of tax activity, as Steve alluded to, around streaming services. First and foremost, we have to talk about sales tax, and so quite a few states now tax, sales tax on streaming services, and we've seen that come about in some different ways, right? And so some of the states that are applying sales tax to streaming services are doing it under, existing pay TV definitions that they applied to cable and satellite television. Some are applying it on, other definitions that they had on the books for application to digital goods and digital services, and some have actually moved to enact or pass new regulations or come at it that way. So different approaches of how it's gotten there, but sales tax has become relatively common, not universal. There are some states that don't have sales tax on streaming services, but quite a few that do. And then, kind of the interesting part to us here in the communication tax world is what else besides sales tax comes into play. And so there are at least a handful of taxes that have already come into the picture as being part of the conversation when it comes into streaming services. And it's not a super long list at this point, but these are some pretty notable locations and also some fairly painful taxes. So we'll dive into that as we go. But Florida has extended their communication service tax, or has interpreted their communication service tax to apply to streaming services, and we'll spend some time with that one. Kentucky has an excise and utility tax that they're collecting from streaming services. Some local utility taxes in California have come up in some significant jurisdictions that would apply. And then Chicago, of course, a not insignificant place that has also rather famously applied their amusement tax. And then what else is on the horizon? So we know that there are several states that are actively considering or have actively considered enacting new laws applying streaming taxation. And so there's a list of some of those jurisdictions. And this is only likely to expand. As we've all been reading the headlines the last several weeks, state budgets are in big trouble. For a lot of external reasons beyond just the fact that cable taxation revenues are shrinking. And so there's likely to be an increasing movement of states trying to find additional ways to tax online and remote services as that continues to grow and become a bigger and bigger part of our economy. And streaming is almost certainly going to be a piece of that. And so here's 5 states that have had legislation considered here over the last several months. And then there's also a likelihood that we're going to see, a wider, movement beyond that. And I can't tell you what or where yet at this point. But, I feel very confident that there will eventually have a likely, ripple of further jurisdictions that are going to move things along. And so.
Right. Yeah, and one point we want to make at the outset is that this doesn't just, these taxes don't just apply to kind of, lean back traditional pay TV replacement services, right? A lot of the statutes, a lot of the regulations are taking a pretty expansive view of streaming, right? And so obviously these are going to pick up entertainment services like IPTV, VOD subscriptions, kind of standalone TV anywhere, kind of traditional cable net services and sports leagues. But it's also it's also pulling in other verticals within the streaming segment, right? So fitness is a big piece, whether these are standalone subscriptions or tied to, at-home exercise equipment. Obviously subscription services around music and internet radio. But then even things like faith and religion, right? So houses of worship are increasingly offering subscription services with content tailored to their audience and congregation. And so we've got customers that cut across all these verticals who are faced with new challenges around taxation for their streaming services.
Yep. And so, yeah, turning back to Florida, I promised earlier we'd spend a little time talking about Florida, because obviously that's a fairly significant state for a lot of folks in terms of population and economic value. And it's one of the more clear-cut streaming taxes that first appeared on the landscape. And the Communication Services Tax, a little background on that. This is something that came around in the early 2000s. As a response, Florida was trying to come up with a way to be a little bit more inclusive with their revenue collection on at the time phone cable services, and so they implemented this tax with a really sort of broad, forward-looking definition. And if we look at some of the language here, this is from the definitions of the Communication Services Tax. You can see that they've obviously they make a reference to audio and video, which is fairly important, but then they start talking a little bit about the transmission aspect of it, and they talk about how it could be electronic or radio or over a satellite or over cable. But then here's the really key kicker is they include this language or anything else basically that anybody could possibly come up with, right? So Florida, when they did this, was clearly trying to future-proof their communication tax, and in this case, it kind of you could say it paid off in bounty when streaming became a significant player in the market, because Florida was in a position that as streaming gained relevance, they were able to look at the existing statute here and say, look, we already have language here that says however you deliver this, it is subject to our communication services tax. They had originally, come up with this language back when we were worried about, voice over IP displacing phone services. And, that probably was a strong motivation in driving why we have this really, forward-looking definition. It also kind of raises the question, though, so and this is true of all of those, example states that we mentioned a couple slides back, is that these are states that, for the most part, had existing language on the books that was open or broad, like this Florida example, that you could already interpret in streaming services, which raises then the question of what is the forward-looking? What is the path going to happen that states are going to react and actually modify things? That's kind of the consistent thing with Florida and Chicago and California jurisdictions, is that some of these places had some of these rules already on the books with application to or open to application with streaming. It's only going to take some simple legislative action to change other locations to be similar. And so, turning to Chicago, this is another interesting and instructive use case. So Chicago has had this amusement tax for a little over a century, and so the original text of the Chicago amusement tax, you can find references to things like livestock exhibitions and fairs and vaudeville and that sort of thing. So this was written for a very different time, and Chicago has sort of enhanced and expanded the rules and definitions over time, and so you still see references in there to some of that really sort of antiquated activity. But then they also put in a provision about paid television programming, which paid television programming, okay, that sounds like it would probably cover a lot of streaming services potentially. And similar to Florida, they've got this language in here. Now they list off, known tangible transmission things, wire, cable, fiber, et cetera, but then, or similar means, which is, obviously pretty open-ended. And so that has allowed Chicago to interpret that streaming paid television programming over the internet would also be subject to the amusement tax. So a little bit of some of the detail about some of these items that we can say are additional responsibilities outside of sales tax. There's some variants of what you need to be aware with the mechanics of how some of this stuff works. So Florida, for example, there's both state and local components of that tax. So there's a state rate, and then the cities and counties all have separate rates. You do get to report it all through the State Department of Revenue, so that's a little bit of a relief, but you do need to keep track of all of those individual local rates and handle that for compliance. California UUTs are kind of an interesting story on themselves. So these are all locally administered. There's no statewide organization for utility tax in California. So all of the cities have their own ordinances. And there have been different model ordinances that have been enacted over time. So some of them have very similar language. There's a couple of variations of common language there. And so some of those, local home rule utility taxes in California have language that is very open to the interpretation that it applies to streaming media services, or at least some streaming media services, and some of those jurisdictions have been very vocal with the opinion that they feel that their existing definitions apply to those services. Not all of the cities have that same language that is open to that application, though. So that in some ways that makes it a little bit trickier, because it's not just a case of needing to go out and see if you get compliant with collecting and remitting tax for all California utility taxes. You have to kind of be aware that it's an a la carte menu, that some of them are down that road and others are not. And then Chicago Amusement Tax, as we mentioned, that is a local tax, and it is administered directly by the Chicago revenue authorities. And then Kentucky is an interesting hybrid. That Kentucky, we're actually got multiple taxes there. There's state excise tax and local utility taxes, and you wind up with both state and local administration components there. So that makes that an additional potential headache to be aware of. One thing that I strongly urge people to be cognizant of when you're talking about streaming services and taxing streaming services is that it is definitely not a homogeneous product world that we're talking about. The world of streaming is actually quite a bit more diverse. And I might say streaming media and how do you tax streaming media, but that means a lot of different potential decisions about what we're talking about, and all of those decisions can actually play into different outcomes of taxability. And we're seeing tax jurisdictions considering several different elements in triggering whether or not it's either going to be sales taxable, or also whether or not it's going to be subject by to other tax obligations. And so first important thing there is what type of media are we talking about streaming? Is it video? Is it music? Is it games? Oftentimes in a lot of states, whether or not those items in their non-streaming form is taxable is informing whether or not they would be taxed in their streaming form. So that's one consideration, what type of content. And then how is it delivered? Is it on the network? Is it being sold by the cable company or the phone company that is providing the network connectivity to the customer? So for example, there's streaming products that are available from some of the big cable companies, Comcast and Spectrum, and the phone companies have some on-net streaming products as well. And there's some indications that there's jurisdictions that feel that if it is delivered on network, then perhaps it should be subject to the franchise fees in that jurisdiction or other utility receipts taxes that those incumbent network operators are normally subject to on their other services, versus if it's an over-the-top service, which means you're delivering it on somebody else's network, then obviously that probably would put you down a different path for taxation. And then there's also an indication that a distinction for tax purposes is going to rely upon whether or not this is a live content or an on-demand content. And we've seen this in some of the tax definitions that, for example, a live TV product may be distinguished for tax purposes from, say, an on-demand video product. And then finally, another key distinction that I think will continue to grow in its importance of delineating the taxation here is how are you operating from a monetization or a business model of selling these services. So obviously, we're familiar that a lot of these services are offered on a subscription basis, like your Netflix or your Hulu services. But then there's also a lot of transactional products in the streaming media environment. So where you might pay per use or to rent, for example, a movie or a song, or a purchase model where you're actually buying a right to continue to access or view the content indefinitely or for a longer period. There's indications that's a significant tax distinction. And then finally, there are revenue models where the user is viewing advertising clearly, and that's going to be the primary driver of taxability. And so that's a further potential path that could take you down a different direction for tax considerations. The takeaway here is that not one product skew, right? These are all different categories for tax treatment, and you need to not try and fit your product into a one-size-fits-all tax consideration, because it looks pretty clear that all of these variables are going to potentially drive different outcomes of what taxes apply and where. And here's some illustration of that. If we turn back to the Chicago Amusement Tax and the same tax ruling that we referenced earlier, it goes on to state that clearly it applies not only to shows, movies, videos, music, and games. So that kind of covers that first line. That here Chicago is clearly targeting all of those forms of content, but not all taxes would follow the same. But Chicago makes a real clear delineation here that the amusement tax only applies if it's a rental or a subscription model that you're selling it. If you actually sell a permanent license or download of the product to possess indefinitely, then it wouldn't be subject to Chicago amusement taxes. This kind of clearly makes clear here. Now, to be clear, that does not mean that you're off the hook for tax altogether. What it means is that if you have a sale, you're going to revert to the sales tax treatment as opposed to the amusement tax treatment. But it's a good illustration that some of that diversity will make some key differences as to what taxes you need to consider and how you apply them. Bundling is another really important consideration when we talk about the digital content and streaming services in particular, because these products are frequently getting bundled in with other things. And we've seen a couple of interesting developments that have raised some significant bundling questions. One of them, Prime memberships for Amazon. So as many of you, I'm sure probably a great many of our audience today are likely Amazon Prime members. So you're probably familiar that your Prime membership, entitles you to a membership in their Prime Video program as a subset of what you get with your annual membership fee. Well, when Amazon went to get tax compliant in Iowa here a couple of years ago, they went and sought a revenue opinion from the state about whether or not that prime membership should be subject to sales tax there in Iowa. And we got back a public ruling on that kind of opened a lot of eyes, because they had kind of a couple of interesting outcomes with it. The state of Iowa determined that, in their opinion, the entire prime membership was subject to sales tax. And their basis for that decision was that the subscription included this prime video component, and Iowa first, as part of that ruling, announced that they thought that the prime video subscription was essentially functionally equivalent to cable, and they taxed cable, and so therefore subject to sales tax. But then further, that because it was included in the bundle, the entire package needed to be subjected to sales tax, which was kind of a pretty harsh outcome. And I believe Amazon even came out and had indicated that they thought they had an established value they could position for, what portion of the package was attributable to the Prime Video. And I think it was, estimated somewhere in like the $5 range. But, that piece being a part of the overall package was enough that Amazon wound up with the entire membership subject to sales tax there in Iowa. So be careful with the bundling and what you package the services with. Now, a lot of states, what we've seen with bundling of other communications products will take, a little less of a harsh line there. A lot of states will take a stance that if you can establish a value on your books and records that can facilitate unbundling that for tax purposes, they'll accept that as a rationale. But this is kind of a bit of an alarm bell decision that came out of Iowa, that they're kind of back to that hardline standard that if you put a taxable item in with some other non-taxable stuff, the whole thing becomes taxable. And then the other consideration with bundling that we have to talk about is when you include quote-unquote free access to some of these streaming services as part of a package for selling other stuff. And the glaring example we see with a lot of these are a lot of the cell phone companies now have offered, you buy our talk, text, and internet plan, and we'll throw in, free Netflix or free Hulu. You see the T-Mobile example up here on the screen that, if you buy their standard, monthly package, you're going to get access to Netflix and get a free subscription as part of that. The word of caution there, that I would always, advise, and this is true of bundling in general, is that when we're talking about bundles of communications products, free is kind of a non-existent word. Your parents may have told you years ago that nothing in life is truly free. And when we're talking about, bundle packages, that is doubly true, right? And so tax authorities are very unlikely to accept the rationale that, if you have this $40 package that represents, a collection of talk, text, data, and access to Netflix, that none of that package is attributable to the Netflix, especially if it's a state where the streaming service is subject to tax, and maybe some of the other components like the internet on the plan are not. And so make sure that you're factoring for that, even if your marketing department refers to it as free, and the sign out in front of the store says, free Netflix. Free, does not typically mean free in this context, and you're going to want to make sure that you're careful with that and have looked at whether or not you need to attribute some portion of the package to that. And to underline that, we go back to our Chicago Amusement Tax definitions. And here we see they actually have a provision in that tax ruling on amusement tax that references bundling, and they actually kind of take a page out of the property tax book as it references there. But the outcome of it basically is that if you fail to separate your amusement taxable service from the non-amusement taxable services, then Chicago has indicated in this pronouncement here that they would take the position that the entire thing is deemed taxable unless you would be able to prove that 50% of the price is for something else. So interesting outcome there. Another kind of harder line response to bundling, similar to what we talked about in Iowa, and another thing to be aware of. And so, Steve, I think that takes us to another poll question.
Yeah. So
Yeah.
so we just this is our third and final poll question. Thanks, Toby. So what we're asking here is how accurate was your prior understanding of the Chicago Amusement Tax? Trying to get a gauge here for awareness and what people may have learned. Give it a few more seconds, we'll cut it off. All right, let's take a look. Cool. All right. Well, yeah, it looks like there was some good awareness that hopefully was built over the last few minutes that was valuable and helps inform how folks are thinking about managing tax and compliance going forward. All right, Toby, I'm just going to kick it back to you. Toby?
Yep. Sorry, I guess. So we promised you some information about how to practically address some of these considerations. And most important thing there, and this is something that's true with most aspects of transactional tax, and maybe I'm not telling you anything that you don't already know, but it's really important to make sure that you keep up with what's going on with the changes. And this is an area where no doubt there is some significant volatility likely on the horizon, that we're going to see more jurisdictions, either pushing out new regulations or new statutes or new enforcement actions. Unfortunately, a lot of policy does get driven through enforcement action more than legislation. And so it becomes really important that if you and your organization are responsible for, the filing or the calculation or the management of these communications taxes, that you need to, be on top of what's going on. And then, we also, of course, would suggest proceeding with caution. If you are thinking about adding, a streaming service to your package, maybe you have a existing offering of software, technology services, communication services, and bundle in, some streaming or digital content, or maybe you're going to add that to a portfolio of existing stuff. Then make sure that you can kind of look ahead and see where you're going, what jurisdictions, what the likelihood is. Does this trigger the possibility that maybe I need to add a registration for a tax that I didn't, previously have to comply with? Because obviously there's a little lead time sometimes in registering and getting compliant for some of these things. And then making sure that you have, and this is the thing that's near and dear to us, our hearts here in the Avalara for communications business, is making sure that you have, technology, up and equipped for dealing with some of these items. Do you have billing and invoicing systems or payment systems that are capable of presenting to the customer both sales tax and then potentially, other items, the Florida Communications Tax or the Chicago Amusement Tax or California Utility Tax or whatever else may come into being? Is this something that your point of sale or your bill is capable of printing out? And can you provide all of the detail about those taxes to the folks within your organization, or if you use outside vendors for handling your registration and remittance pieces, are you going to be able to give them the information that they need to be able to file some of these other items, the Florida and the California and Chicago, et cetera? And do you have the ability to get, for example, both the state and local components in, Kentucky and Florida and some of the other issues that come with that? And so making sure that you're equipped essentially to handle all of that.
Right. And then that's just, as Toby touched on, that's a little bit of a segue into our services within Avalara for communication. So just to spend a quick minute here, one of the things that is unique about our capabilities is that we do provide an end-to-end solution. So we not only have a very robust tax calculation engine, but we also have an integrated returns, filing, and payment platform and service that we can stitch into that as well. And so, just a couple of other points. One is we are a multi-tenant SaaS service, and we provide a lot of ways for customers to get access to the platform. That can be through the pre-built connectors we have with a lot of popular subscription management platforms. That can be through a direct integration with our API. But then we also have a file-based batch capability that a lot of customers utilize. And then from an engine perspective, just a couple of points that I would make is, again, it's a powerful engine, but it's easy to use, right? We offer a lot of powerful features for customers that need it, in terms of tax-on-tax logic and bundling rules and overrides and things of that nature. So it's very complete in terms of being able to service a lot of the requirements that are out there. And then, from a content perspective, right, I mean, we really cut across all of communications and media, right? And so we have content where we can power this globally, but also we've got a robust library of real-time content that we constantly manage and have a dedicated team around that, where we're ahead of changes in rates, rules, new jurisdictions. And so streaming media is a big part of what we've been focused on and we're staying on top of and we'll continue to do so. And then, again, we touched on ease of integration, right? It's easy for customers to kind of get into this platform, integrate it with their billing or transactional services, and is something that we think provides a lot of value for customers. So with that, I think, we're tracking on schedule and can move into Q&A.
Thanks, Steve. So we do have quite a few questions that came in from the audience. So I want to thank everybody for sending in your questions. First question, I think this is probably a Toby question, but would you say educational streaming products would be considered subject to Chicago Amusement Tax?
I would say potentially yes. Now the big caveat there, and this is true not just with the educational content, but we've seen some religious streaming products as well, is that you're obviously probably going to be dealing with a lot of potential customers that are maybe subject to exemption, right? So if you're selling to public schools, universities, or in the case of some of the religious content, we've seen examples of that you might be selling to, churches and other houses of worship. A frequent issue then becomes that, it's a heavily tax-exempt customer base. And so while the service, the product may be taxable, you have kind of a double-edged sword that, you're not going to necessarily be collecting tax, but there is a significant burden and consideration that you're probably going to need to collect, documentation of the exemption status for all of those operations. And so that is an interesting thing. And again, it gets at what Steve was talking about, that, there's a really growing diversity of what these products look like. And educational and spiritual is a big market area of growth in this area, but that is the really unique tax implication is managing those exemption certificates.
Yeah, and Toby, just one thing I would add to that is, the exemption rules don't necessarily follow the rules around sales and use, right? So, there's exemption certificates for the sales and use component, and then there's a unique set of guidelines and rules and statutes around exemptions for contacts. And so, at Avalara, we've got our cert capture solution, and so we've got a lot of experience kind of powering those exemption needs for customers to kind of handle the workflow for those exemptions, but also integrate it real time into their e-commerce experience, where it can be really frictionless in terms of collecting those exemption certificates. But that's a whole separate kind of layer of complexity.
Great, thanks, guys. Have another question here for Toby. When you're bundling and including free content, The question is, do you think carriers should include the cost of the free content in the bundle and apply tax where appropriate? Or is paying use tax an easier option? And are you aware of any companies that are including it in the voice text data bundle? So quite a bit to unpack there, but I think, Toby, you probably know what that question's all about.
Yeah, well, my opinion, and full caveat that obviously, you're going to want to review this with legal and regulatory counsel, but my opinion on that is yes, that it is likely going to need to be considered part of the package. And we look at analogies, a lot of these packages are marketed that they have, quote unquote, free text and, free, free calling and free data allotments and that sort of thing. And so free, in all of these, of course, it's not really free. That's what we're paying the $40 for, the $50 or whatever. And one thing, though, it's not all bad news, right? So in the context of, say, a mobile phone, talk, text, and data plan, sometimes this may work in your advantage, right? So if you're in a jurisdiction where maybe streaming is still not taxable or still only subject to sales tax, having some portion of that bundle price allocated to the streaming may actually work out, to your favor, right? Having something that's only sales taxable or not taxable at all is obviously going to be, typically less taxed than the voice or the texting component of it. So it's not necessarily a bad thing, but my opinion, yes, would be that it does probably need to be considered at least a portion of the bundle package. And then, yes, to answer the question of am I aware of any of the big operators doing that is true. Yes, there are companies out there that are considering that a part of the bundle allocation.
Great, thanks, Toby. Another question, how aggressive are tax auditors in pursuing video providers?
Yeah, well, it's an interesting question. So this is all kind of in a very interesting phase that, this is very new in a lot of places, right? So there are instances where we've seen some enforcement action. Chicago probably be at the forefront. I know firsthand that there are folks out there that have received nasty grams from Chicago on the amusement tax in relation to items that were maybe only sales taxing. And Florida has always been, fairly aggressive in auditing on the communication service tax and enforcement on that in the first place. So no real, change there. But there's other places where I think there's clearly that the jurisdictions and industry are both kind of feeling their oats with this, so to speak. And so like the California jurisdictions, for example, there's a kind of, I would say, a degree of tentativeness just to the extent as to how aggressive some of those cities are and actively going out and pursuing. And obviously they're different, jurisdictions, and that's not to caution that you just ignore them. But enforcement's likely to grow, though, as we talked about, that the budgets are empty, and I can tell you, having worked in tax automation and compliance through multiple recessions now, that when state and local government go through recessions in general, they are always looking for new issues to audit on, and typically what is going to get the attention is going to be the businesses that are succeeding, right? So all of these headlines about how many people are signing up for these streaming services, and Steve's bar graph earlier about the skyrocketing subscriptions to streaming services. Well, you can be sure that the state departments of revenue and the folks that are planning their audit calendar see those articles too, and so when they're trying to plug those revenue gaps, the industries that are succeeding in the times of crisis are certainly going to be ripe for additional attention. So be prepared. This is the answer on that.
Yeah. Yeah, and I think what we would also say is it's not just the growth; it's the growth compounded or coupled with kind of hollowing out an existing tax receipt base, right? That just drives a lot of scrutiny.
Exactly.
Okay, I think this is also another Toby question and something I'm actually very curious about, so I'm glad that someone asked this question. But what taxes apply when you're talking about streaming audio services? We've talked a lot about streaming video, but what is the tax implication for streaming audio?
So streaming audio is kind of an interesting thing. Streaming audio didn't have as much of a clear-cut, pay subscription product, that preceded it, right? In the legacy to streaming video, we had cable and satellite television, right? So there was kind of this existing model, but the predecessor to streaming audio was terrestrial radio, right? We all listen to our radio for free on an ad-based, model. So there was not as much of a precedent of people paying to listen to content, and according to that, there weren't as many past references and statutes and laws to taxing any form of audio services. So it's been a little bit of a bigger reach for the jurisdictions, but there are some indications that it's out there. So, for example, that Florida language that we looked at, if you may have noticed highlighted in orange, we had audio highlighted. That's part of the definition, and Florida has indeed made it very clear that they think that communication services tax applies to subscription, online radio and satellite services and podcasts and all that sort of thing if you charge for them. And so that is growing. It's not quite as aggressive as the taxation that we've seen on video, but not for want to, right? So obviously as people pay for these products, just like everything else, that's a growing market area and something that will continue to get attention. It's just been slowed a little bit by the fact that there's not a history of an analogous paid product in the past.
Great, thanks, Toby. We just have time for one more question, and this last question is, will streaming services ever be subject to franchise fees?
My thought would be not widespread, right? So as Steve had on his slide earlier about mentioning the types of taxes that have historically applied to cable television. One of those, of course, is the municipal franchise tax, and these items are franchise fee. These items came into existence to sort of regulate the activity of cable and other utility companies in cities, making sure that they fit certain levels of public safety and, built out networks all over the whole city and maintain certain levels of service. You got kind of a monopolized franchise grant from the city. And in exchange, you typically paid a fee. The public policy argument of a franchise fee just does not translate well to these streaming or, internet-based services because of the fact that by definition, particularly if you're an over-the-top service, you're not using the public rights of way, right? You're not actually getting to the customer over your own network of services, and you're not going to be out digging in the streets or hanging things on overhead lines and whatnot to deliver these services, unless, with the possible caveat, it is one of these on-network based products that there's a potential, and I think there are some early indications of some places where there's some possibility of some attempts there, at least to define, to say that if you're a network operator and have the wires, the cable, then maybe you would include that in your franchise revenue base. But I don't think that will ever be a widespread application to these services.
Yeah. Hey, and Toby, just to kind of build on that is I think what you said is right. It's unlikely you'd see a franchise tax, imposed on streaming taxes, but, those are a significant source of revenue. And so as that revenue gets depleted, while it may not be directly replaced, it may be indirectly replaced. And again, be a catalyst or a driver for other streaming services.
Yeah. Does that mean that the jurisdiction then goes out and puts their own, digital services tax or utility tax or com tax as a replacement for those revenues is entirely a possible direction.
Great. Thank you, guys. That was a fantastic webinar, and just wanted to give you a couple of final reminders here. On24 will actually send this recording out to you within 24 hours. As well, the website you used to sign up with on avalara.com will be converted to an on-demand viewing option in a little bit of time here. So go ahead and click back on that later on if you want to share that with anybody or view the webinar again. Also, just so you know, this is a very hefty topic. There's a lot of information that we go through. So if you have any questions or want to send me an email, feel free to go ahead and do that, and I will answer those as much as I can. And then as well, a survey will pop up at the end of this webinar. We'd appreciate your feedback, your thoughts, anything else that you can help us as we make more webinars going forward. So just wanted to say thank you again for attending and have a wonderful rest of your day. Thanks so much.
Yep. Thanks, everyone.